Hello. In this video, we'll continue with our discussion of the allowability with respect to Section 162, General Business Deduction. Now recall that if there is an outflow by a taxpayer and the issue is whether it can be deducted as a business deduction, there has to be 7 propositions that must be met. First is that the outflow must be ordinary, it must be necessary, it must be an expense, it must be paid or incurred during the taxable year, it must be in carrying on any trade or business, and finally, there must be adequate substantiation. So this video will consider the last 2, trade or business as well as adequate substantiation. At the end of the discussion of adequate substantiation, I will bring together all the propositions just as a reminder and a little summary. So let's dive into trade or business. So does the expense, which we considered in a previous video, whether it's an expense or capital expenditure, so at this point, if you're coming along the checklist, you've determined it's an expense, does the expense bear approximate relationship to a trade or business activity? So if you recall, there's really 3 different types of activities. So over here on the side, 3 activities with respect to income and deductions. There's business activities, there's investment activities, investment activities, and there's personal activities. Now the first 2, the tax code has given the phrase gain seeking or profit seeking. Gain seeking or profit seeking. But remember that in the introduction discussion, that taxpayers generally prefer to have business over investment because with business deductions and there's less limitations and there's a higher chance you actually can deduct with respect to the amount. And another thing is we're going to talk about at the end of this is that business deductions, many of them, well, with respect to an individual taxpayer, almost all of them are considered above the line. So with respect to determining whether something is trade or business, there's 2 cases that I want to discuss because these 2 cases are both U.S. Supreme Court cases. So the 2 cases that I want to mention, the first was the 1940s case, and this is the main case with respect to determining whether something is business or investment activity. So that's really going to be our focus, is how do you distinguish between business or investment? I mean, personal, okay, there's no gain-seeking or profit-seeking nature. But with respect, there's 2 cases that really highlight what exactly makes something business over investment. So case 1, we'll talk about over here, and case 2, we'll talk about over here. So the first case is Higgins versus Commissioner. And both these cases went before the U.S. Supreme Court. So in the Higgins case, the court determined that just because an activity is gain-seeking, meaning that it's held for profit, so just because the activity has a profit motive, so just because there's a profit motive in mind, does not mean that it's automatically considered business. If it's profit, it's considered gain-seeking, and that's where we get the gain-seeking notion throughout tax law. The distinguishing factor, and this is brought from the Higgins case, and this is the most important part of the Higgins case. The distinguishing factor seems to be the sweat of the brow notion. Sweat of the brow notion. The idea is that if the amount of revenue inflow is a direct function of the personal efforts, so the personal efforts of the taxpayer or his employees, his or her, again, at the time of this case is 1940s, so I apologize, that was how our society was, so his or her. So the personal efforts of the taxpayer or his or her employees, then the outflow tends to be more trade or business. On the other hand, if the amount of revenue is more of a function of the amount of invested capital, so personal efforts versus invested capital. If the revenue that's coming from these outflow activities is more from invested capital, then it tends to be more investment. So personal efforts tends to be more the sweat of the brow notion. You actually, like, let's say that you own a lawn mowing business and you are actually out there mowing the lawn day to day. Well, that mowing of the lawn, the personal efforts, seems to be more trade or business versus invested capital. If you're a limited partner in a lawn mowing business, but you don't do anything with respect to the business, you're just investing money. You're investing capital so that the business can grow. That seems more as an investment activity. That's really what the Higgins case focused on. Now, that seems, it can get very, dicey. There's a lot of overlap. So another case was commissioner. So Commissioner of Internal Revenue, it's always CIR, versus Grotzinger, Goretzinger, Commissioner versus Grotzinger. And this is a more recent case. This came in the 1980s. In this case, they added to that, another focus needs to be continuity and regularity with regard to the activity. Because the idea is that if you are a partner in a partnership and you are investing money, then yeah, let's say you it's a real estate business. Yeah, you can go out and you can do some management every now and then. Maybe you're cleaning every now and then. Maybe you clean when the tenant leaves, but that's not necessarily held to be business. You can still be an investor, just doing some work. So the key is that sweat of the brow notion, and that was continued with regard to the Grotzinger case, but it has to be continuous and regular. If it's not continuous and regular, then it's not considered business activity. Now, if it's not business, you're going to see in the investment and the personal discussion that you can still continue down the line over here, and you can consider whether it's investment or personal activity. If it's not investment, then it's automatically, then personal is basically the fallback. And again, taxpayers, the worst case to be in terms of these three is personal because it has the most limitations. The general rule is that you can't take a deduction for personal activities. So now let's consider adequate substantiation. Is there adequate substantiation showing proof of the expense? I want to note something. In section 162, there's no explicit requirement for substantiation. There's no explicit requirement. So I need to explain how this developed. Really, in 1930, there was a landmark case. It wasn't a U.S. Supreme Court case. It was Second Circuit, which is a powerful circuit. Second Circuit case, that's the circuit of New York. Second Circuit case, and it's Cohan versus Commissioner versus CIR, Commissioner of Internal Revenue. And in Cohan versus Commissioner, there was an actor, George M. Cohan, who he attempted to deduct large, unsubstantiated travel and entertainment expenses. The Second Circuit instructed that in such cases, the taxpayer must substantiate the fact that outlays were incurred, but that substantiation of the amount was not required provided the estimates were reasonable. Now, since that case, the law has pretty much been, and this is known as the Cohan rule, and the Cohan rule says as long as it's reasonable with respect to the items that are provided, the burden, since this case, the burden has become on the taxpayer to show these items. So if the IRS ever questions this, the burden falls on the taxpayer. And that really was developed from this case. And it's a very reasonable method. It's very loose. But again, there's no explicit requirement. But again, through the case law, and the Cohan rule, Cohan case is the main case where that came about. Now, in the early 1960s, Congress said, you know what? It's becoming out of control. It's unreasonable, the level of substantiation that taxpayers are providing with respect to these items, and because of this case law, it's going haywire. It's going out of control in terms of they're taking deductions and they're just showing bare bones, receipts. Maybe they're even writing their own receipts on paper just to keep track of it. So in the 1960s, we have Section 274, which the 260s and 270s are limitations on deductions. So 274 is a limitation. And within 274, we have section 274D, which lays out substantiation requirements for certain provisions. So this does not apply to all deductions, just certain ones that specifically say, oh, you must follow section 274D. And there's 5 specific requirements that section 274D lays out. Those 5, the amount of the expense must be provided, and this has to be shown. Whether it's on paper, it's electronic, it has to be shown. The amount of the expense, number 1. Number 2, the time and place of the expense. Number 3, the business purpose of the expenditure. Number 4, all of the parties associated with the expenditure. And number 5, the business relationship of all the parties. So this had to be provided. These requirements made it more stringent with respect to what had to be shown. And since that time, the IRS has tended to use this provision to apply to other areas, and this has been one of the most contested areas since the 1960s, because within a code section, it might not specifically say 274D applies. For example, section 162 has no requirement explicit about substantiation, but since the Cohen rule, there has been a burden pushed on the taxpayer to show. So the IRS comes in after 1960 and uses this provision. But Congress did not intend it. They meant it for things like meals and entertainment. So meals and entertainment are a perfect example. Meals and entertainment, you have to show 274D level of substantiation. But general business deductions, like section 162, you don't have to meet 274. And there's other types of deductions where you have to meet 274D levels. Now, I always, when I'm advising clients, taxpayers, whatnot, in terms of the level of substantiation, I always say at 274D, if you do 274D, those 5 requirements, you will be in good shape with regard to any issue of deductions, because that's what Congress laid out, and the IRS can't go further than that. Now, you can always go further, and that's going to be less, of a dispute between you and the IRS. However, 274D is what Congress wrote, and that's actually, the intentions of Congress with respect to the most hotly contested issues with regard to substantiation, so that should be fine. So there has to be some level of substantiation, is the idea. So if there's a continuum, you need some, right? You need some for any type of deduction. And on the other end of that spectrum, you have 274D. That's the most stringent requirements. Those 5 requirements have to be specified. So, whether you have some, which, maybe you've written it down, but it's not between the parties or whatnot, just these items, you have to have shown those, those specific things, but usually needs to be at the time of the transaction is the key with 274D. So just keep that in mind. There has to be adequate substantiation. So now that we've concluded all 7 requirements, so if you fail any of these 7 requirements, you don't have a business deduction. Now, whether you can continue along, whether it's investment or personal, you have to consider the other videos. If it's not an investment activity, then you're going to see it's going to be a personal activity, which the general rule means that you can't deduct. So I just want to summarize quickly the 7 requirements again. So we have the first requirement is that ordinary. The second is necessary. Ordinary and necessary are viewed together. Ordinary will look at a reasonable response, a reasonable reaction to the outflow. Would a reasonable person actually make that? Necessary looks more at whether it's appropriate and helpful. The third criteria of the 7 is that it must be an expense and not a capital expenditure. This deals with timing, very similar concept from financial accounting where we capitalize an asset versus expense it. Same idea. If it benefits the current year, then it's going to be expensed, but if it benefits more than the current year, beyond the current year, then you have to look at the analysis. If it's a new item, you have to capitalize, but if it's an existing item that you're doing some type of outflow on, then you have to consider various things like arresting deterioration versus prolonging life, whether it's a repair versus a replacement, whether it's maintenance versus it's an improvement, betterment. You have to look at increasing value versus not increasing value, just maintaining value. Those kind of things. Paid or incurred during the taxable year is the 4th. This dealt with the method of accounting. If your cash method, it's when it's paid. If your accrual method, it's when it's incurred. The 5th is in carrying on. This deals with, are you already in the business line? If you're not, then you can't deduct under Section 162, but remember, Section 195, startup expenditures, provides a special rule. 6 is any trade or business, which we talked about here. So it must be a trade or business. So remember the Higgins case contrasted investment versus business activity, and then Grotzinger brought on the continuity and regularity. And then 7, there must be substantiation. Now, before I end the video, I want to talk to you about, generally speaking, business deductions. Almost all of them are above the line. And we talked about this in the introduction topic, above the line deductions, which are the best type. So that's just something important to keep in mind, because when we determine whether a deduction is above the line versus below the line, I just want you to keep in mind that almost all business deductions out there are above the line deductions with respect to an individual taxpayer. If it's a corporate taxpayer and you're doing a corporate tax return, it makes no difference. There is no above the line versus below the line deductions. It's just a deduction. But if it's with regard to an individual taxpayer, almost all business deductions for an individual will be above the line deductions, because they actually affect they're actually reported in the right below the gross income item. So just keep that in mind. So this ends our discussion of general business deductions.